Good morning, all of you. Today's topic is cost analysis. It is coming under Unit 11, Block 3. In this particular topic, we are going to discuss about the cost. What is the meaning for the term cost and what are all the different cost concepts available in economics. After that, we will summarize and what are the semester in question possible. These are the things we are going to discuss today. The main objective of this particular topic is to understand and analyze various cost concepts in economics. In manager economics, the cost analysis demands the knowledge of realities in the business world, as it influences all the economic indicators right from purchase of raw materials up to rendering after sales services. In accounting or commercial sense, the cost is classified into two categories. One is a direct cost, another one is indirect cost. But in economic sense, the classification of cost ranges from opportunity cost to adoption cost. The term cost can be defined as the amount that has to be paid or given up in order to get something. In business sense, cost is usually a monetary valuation of effort, materials, resources utilized, time utilized, consumed, or the risk incurred and opportunity omitted during the production process or service rendered. So it is of different context. It is to be noted that all expenses are considered as cost, but all costs are not expenses. The primary objective of any business is to earn more profit, which is possible in two ways. Either we have to minimize the cost or we have to maximize the revenue. We used to call it as cost minimization or revenue maximization. In order to minimize the cost, one should be clear with the idea about different types of costs. Let us discuss one by one. Different types of costs we will see. There are a variety of cost concepts which are differing from the purpose of business, type of product, quality of the decision, and maintenance of the business. So based on the context, the type of cost may differ. Even for prediction of future demand, we need the cost concept. Professor Joel Dean has given a cost distinction for classification of the term cost. In accounting sense, the cost incurred and revenue earned are the determinants of profit. But in economic sense, knowledge about the alternative and average of the cost factor play a dominant role in business decision making. Following the list is a cost distinction helpful to analyze the cost function and the type of cost involved in the business decision making process under managerial economics. The first one is opportunity cost versus actual cost. Second one is past cost with future cost. Third one is traceable cost versus common cost. Fourth one is out of packet cost versus book cost. The fifth one is incremental cost versus sunk cost. The sixth one is avoidable cost versus unavoidable cost. Seventh one is private cost versus social cost. Eighth one is shutdown cost versus abandonment cost. Ninth one is implicit cost versus explicit cost. The 10th one is controllable cost versus non-controllable cost. The 11th one is replacement cost versus historical cost. The 12th one is short-run cost versus long-run cost. The 13th one is fixed cost versus variable cost. And 14th one is semi-variable cost. And finally, total cost, average cost, and marginal cost. So let us discuss one by one. First, we will compare the opportunity cost with the actual cost. The opportunity cost may be defined as the expected return from the second best alternative of addition or use of resources. In the other name for opportunity cost is called alternative cost. For example, suppose an individual has a sum of rupees 50,000 for which he has only two alternative uses. Either he can buy a Xerox machine or a computer system with printer. From the Xerox machine, he expects an annual income of 12,000 rupees, and from the computer system and printer, he can earn 10,000 rupees. Considering as a profit maximizing investor, he should invest his money in Xerox machine and forgo the expected income from the computer system. Why? Because the opportunity cost of his income from Xerox machine is expected income of computer is only 10,000, because Xerox machine give 12,000 rupees, but computer system and printer give only 10,000. On the other hand, the actual cost refers to the cost incurred by the businessman in payment of factors of production, land, labor, capital, and organization in terms of materials, plant, equipment, transport, and advertisement expenditure, all this. The total money spent on business or tasks which are recorded as in the book are called actual costs, but the concept is called accounting concept. I will repeat again. The opportunity cost of the income of Xerox machine is expected income from the computer system with printer is rupees 10,000. Why? Because he choose the alternative to buy the Xerox machine, not the computer. So the second best alternative cost is called opportunity cost. The actual spend is the actual cost. Let's move to the second type of cost, that is past cost versus future cost. The other names for the past cost is actual cost or historical cost. Past cost refers to the actual cost incurred in the previous time interval. On the other hand, future cost refers to the cost to be incurred in the next time interval, which are calculated through forecasting. This cost gains its importance as it plays a dominant role in managerial decision making, including expense control, projection of future income statement, appraisal of cost or capital expenditure, ground projection of future income statement. So the expansion program or pricing strategy. So for different contexts, this particular past cost and future cost concept is very much required. While comparing the past cost and future cost, the business firm give more priority for the future cost as its usage of cost is more, and past cost is relevant only under the assumption that the cost condition of the previous period would be duplicated in the future too. So past cost is for our statistical data, future cost is for the decision making. Let us move to the next comparison distinction: traceable cost versus common cost. Traceable cost is otherwise called direct cost. It refers to the costs which are identified easily and indisputably with the unit of operation. On the other hand, common or indirect cost is a cost which is not traceable in any particular plant, department, or operation, or any individual final product. For example, salary of branch manager is a direct cost or traceable cost, as salary of a general manager is indirect, is a common cost. General manager means he cannot give a particular thing. Branch manager salary is direct, but the general manager guy is not, because it includes more economic indicators. The use of direct cost is more compared to indirect cost, and secondly, it is difficult to calculate the common cost. Now, let us move to the next distinction: out-of-pocket cost versus book cost. Out-of-pocket cost refers to the cost which involved in payment of cash to the business parties, specifically to the outsiders. On the other hand, there are some costs which does not require any cash payment, but the value are to be considered in terms of actual cost. For example, the value of depreciation does not require current cash payment, but the value entered in the book. The relationship between the book cost and out-of-pocket costs are subject to the manipulation of the transaction. The book cost can be converted into out-of-pocket costs by selling the asset and having them on hire, because as a rent, it would be replace the value of depreciation and interest. Let's move to the next one: incremental cost versus sunk cost. Incremental cost and the marginal cost look alike, but there is a difference between these two. The marginal cost refers to the cost incurred for the 1 unit of additional output, but incremental cost refers to cost incurred to the batch of additional units of the output. I will repeat again. Marginal cost refers to the cost incurred for 1 additional output, but incremental cost refers to cost incurred for the batch of additional units of output. It also includes the changes in the product lines, introduction of new product, replacement of equipment, machinery or plant, whichever be. When you replace a machinery or you replace a plant, even when you expand the production capacity, all this will influence the incremental cost. On the other hand, the sunk cost refers to the costs which are not altered, increased or decreased by varying the level of output, because that particular cost you have to incur irrespective of level of output. In easy words, money spent on investment purpose cannot be revised or reversed or recovered with the change in market condition or change in the business fluctuation. It is called sunk cost. So incremental cost, it is a cost incurred for the additional batch of units, but sunk cost is a cost invested irrespective of the output. Let us move to the next distinction: avoidable cost and unavoidable cost. Avoidable costs are otherwise called escapable cost, which refers to the cost which can be reduced or evaded due to contraction of extra activities of the business enterprises. For example, closing apparently unprofitable branch to escape from the house of storage cost, combining the official of the same route for a common vehicle to escape from the transportation cost. On the other hand, there is certain expenditure which cannot be avoided. Those costs are called unavoidable costs. Then private costs and social costs. Private cost refers to the cost of production of an individual, private or any particular firm. On the other hand, social cost refers to the total cost of production of an industry or cost of producing a product to the society in the form of factors of production, that is the resources which are used to produce it. In other words, the value of resources of an economy which would be utilized for the production is called social cost. The private cost is otherwise called individual cost, as it discusses about one firm or one industry or production of one type of commodity. But social cost is common to all. The next distinction is shutdown cost and abandonment cost. Shutdown costs are expressed in three different economic situations. They are the costs which are incurred in the occasion of suspension of a particular plant operation, the costs which have been saved if the plant operation is continued, and the additional amount paid to restart the plant operation. This is one side. On the other hand, abandonment costs are those costs which are incurred while complete cessation of a particular plant operation or a business activity. In business point of view, both costs are more important to decide either to continue the existing plant or suspending its operation. It is called abandoning the plant once for all. So these three options, a manager has to take a decision. So both shutdown costs and abandonment costs is more important. Coming to the next distinction, normally this question is asked in section here: what is implicit cost or what is explicit cost? Implicit cost and explicit cost is more important in examination point of view. Explicit cost refers to the expenditure incurred by the business firm which are belong to the factors units owned by others. In easy words, the amount paid to the owner of the factor unit which are not belong to the employer itself. The explicit cost consists of all contractual payment such as wages, salaries, payment for raw materials, interest borrowed on capital fund, rent amount to the landowner, and tax paid to the government. All these things are explicit cost. Then what is implicit cost? The implicit cost refers to non-expenditure value for the used factors units owned by the employee himself. In real sense, the cost saved by the owner as he owned the factors. Coming to the next distinction, controllable and non-controllable costs. Controllable cost refers to the costs which are influenced by the usage of factor and administered by specific level of executive. For example, electricity costs, transportation charges, all these things are controllable costs. On the other hand, there are certain costs which is out of our control. Those costs will be involved more than one level of executive. In easy words, those costs which are not controllable at one level of executive, it may be controllable with a higher level of executive, then it is called non-controllable cost. The next distinction is between the replacement cost versus historical cost. Replacement cost refers to the cost to be incurred or paid currently to the acquiring a same plant, but historical cost is a cost mentioned in the financial accounts book at the time of purchase. Actually, how much we paid for that particular machine is historical cost. But what is the latest value for replacing that? How much we have to spend? It is replacement cost. Due to random changes in the price level, historical costs are considered as outdated value and may not be correct value to project the future cost. On the other hand, the replacement cost is a right indicator for expansion of or additional unit or replacing the existing plant or a production unit. So when we compare to historical cost and replacement cost, the replacement cost has more scope in business practices. Let us move to the next one, short-run cost and long-run cost. The term itself gives enough meaning. The short-run cost refers to those costs which are proportional to the output or sale when the plant or other fixed capital equipment remains constant. On the other hand, the long-run cost refers to the costs vary with the level of output or sale, including plant and machinery, because all are variable. In short run, most of them are constant. So short run cost is helpful to decide whether to make or buy. The long run cost is helpful to decide whether to set up a new plant or not. Then fixed cost versus variable cost. Fixed cost refers to the costs which are constant in total amount irrespective of output level. And there is an inverse relationship between the total volume and the fixed cost per unit, because as output increases, the value of average fixed cost will be low, but it never reaches zero. On the other hand, variable cost refers to the costs which are directly proportional to the volume of production. In easy words, an increase in output result in proportional increase in total variable cost, and decrease in output result in proportional decline in total variable cost. So it is directly proportional. There are linear relationship between the volume and the variable cost as they are constant per unit cost. The last one is comparing the total cost, average cost, and marginal cost. The total cost is the sum of total fixed cost plus total variable cost. TC equal to TFC plus TVC. Then what is average cost? It refers to the total cost divided by total quantity produced. AC equal to TC by TQ. Here TC is the total cost, TQ is the total quantity produced. The third one is marginal cost. The marginal cost refers to the cost incurred for one additional unit produced, or the cost difference between the current cost of production with the previous period cost of production. MC equal to total cost in the nth period minus total cost in the n-1th period. Now we can summarize the same 15 different cost distinction given by Professor Joel Dean. Opportunity cost versus actual cost, past cost versus future cost, traceable cost versus common cost, out-of-pocket cost versus book cost, incremental cost versus sunk cost, avoidable cost or unavoidable cost, private cost versus social cost, shutdown cost versus abandonment cost, implicit cost versus explicit cost, controllable cost versus non-controllable cost, replacement cost versus historical cost, short-run cost versus long-run cost, fixed cost with variable cost, semi-variable cost, and total cost, average cost, and marginal cost. Totally 30 different types of costs are discussed in this class. You can expect a section C question, explain cost classification or explain different types of classification. And in section A, the most important is opportunity cost, implicit cost, out-of-pocket cost, and shutdown cost. When the manager want to take a effective decision, he must be very familiar with this cost distinction. Thank you for watching the video. If you have any doubt, kindly contact me. Thank you very much.